Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. It's Quincy Krosby. It is Monday morning, November 13th. This is The Talking Point. The market is opening in the red. How do I say this? The market is dealing with so many different items on the agenda, not to mention the warning that came from Moody's toward the end of the trading session on Friday afternoon, late Friday afternoon, essentially with a warning. And the warning was clear. The warning was, get your house in order. And that basically was focused on the negotiations in Washington, D.C., as Congress comes back, to keep the government open, essentially. And we'll see what happens. There's hope upon hope that they could come up with an agreement, but short of an actual agreement that takes care of the concerns from both sides of the aisle is perhaps a continuing resolution, meaning that this goes on and on and on, but keeps the government open on a rolling basis. So that was the warning. But overall, at the end of last week, I just want to point this out, there was the University of Michigan's Consumer Sentiment Report. It's not the final report. The final report comes out this coming Friday. But that report showed that consumer sentiment coming down and coming down handily. But when you take apart that report, it shows you that the lower wage earners, the ones who were suffering from higher prices, from higher interest rates, they are the major cohort, the major group, unhappy with their situation now and even looking ahead. And also from young people, and also folks that are, beginning to pay back their student loans. All that together brought down the optimism for the economy. And again, the optimism brought down optimism for looking ahead. But embedded in that report is something that is extremely important, and that happens to be expectations for future inflation. Now, this is where it gets interesting. I'm going to say, again, that was the younger cohort and the lower wage earners that were the most concerned about future inflation when it was sort of unwounded, and you could see where the issues came from, which segment it came from. Now, here's where it is. It shows that expectations for future inflation rising, and I have to say rising quite markedly. So let's just say it goes from a low of 3.2%, but up to 4.4%. This is something that the Fed, and for that matter, no central bank wants to see. They do not want to see inflation expectations rising in terms of 1 year or 3 to 5 years. And the reason for that is this. What happens is that you start to have a mindset of, well, we might as well buy it today because it's just going to be more expensive down the road. We may as well just get that work done in our house. It's expensive, but, it's just going to be even more expensive if we put it off. That is a mindset of inflationary thinking taking hold. The opposite, I want to point out there is an opposite, and that is deflation. And what deflation is, don't buy it today. Don't do it today. It's only going to be cheaper down the road. And when that takes hold, it actually pushes prices down. Now, here's the thing. The problem is that the Federal Reserve watches this very closely. And the term that's used when inflationary expectations rise, and rise more than expected, is that inflationary expectations become unanchored. You will hear that term, unanchored. They don't want to see that. So I want to point that out because it is something that Chairman Powell has mentioned in the past as being very important. He has sort of, moved beyond that and said, yes, we watched that, but, leaving too many questions hanging out there. In fact, I have to say this, last week with Fedspeak, the theme was very much focused on, are we really finished? Is it really done? Can we count on inflation coming down at a faster pace? Or do we need to have higher rates for longer or even another rate hike? This was cemented by Chairman Powell's commentary on Friday at the International Monetary Fund, in which I think the market's view of it was, is he trying to be tough because he's seeing that the market goes up, even if it's led by just 7 names, and financial conditions have actually eased as the dollar has weakened, which is, by the way, part of financial conditions. A weakening dollar eases financial conditions actually globally. But the point here is, at the same time, the Fed has said, well, we can rely on higher rates. Higher rates will slow consumer spending. That is a question mark, is it not? It will higher, because another thing that has happened, higher rates, not led by the Fed, but more by the Treasury auctions, as actually higher rates have come down. This is something the Fed does not want to see. So all of this together, coupled with auctions last week for the 10-year and the 30-year bonds, and I don't want to get too geeky now, but you've got to hear this. The 10-year was fine, but the 30-year that auction that we had was actually not good. And what it showed was that foreign buyers of U.S. Treasuries, pulled back. I mean, they just weren't excited about the auction. And U.S. obviously domestic buyers, similarly, leaving quite a bit of that supply with the banks that handle these auctions. It was not good. And as a result of that, the 10-year yield inched higher. You probably saw that. But overall, it was Chairman Powell's comments coupled with a weaker auction that led the market, questioning, where are we headed? And that pushed the market actually higher, but with the big 7 megatech names. And there have been questions. Well, why are the megatech? Why is that the go-to defensive names? Well, it is, and we have seen that over and over again, because investors or traders believe that they have strong balance sheets. They are strong in their individual market areas, their territory, and that has become a go-to, despite the fact, I want to point this out, that you will hear, well, they are long duration names. If rates go up, why should they be going up? We need to analyze this because it seems like a contradiction to many, but the fact is that they have become seen as a defensive group of names. That's what we are dealing with in the marketplace. So let's get to what's important this week. A couple of things. One is the meeting out in San Francisco that is scheduled between China's President Xi Jinping and President Joe Biden. Before this meeting took place, there has been a number of meetings between high-level officials between the U.S. and China, leading to what would seem as a minor breakthrough. But invariably, over the years, it has shown that it is more than a minor breakthrough, that it is, in fact, perhaps an opening, and that is soybean sales. China is the largest user of soybean products, the oil and so on. And they moved away from the United States, to read what farmers had been saying. They moved away from the U.S. and going to Brazil and Argentina as their main suppliers. Lo and behold, there have been a number of purchases before the official opening of this meeting. That may be an indication, or at least the market is hoping, indication that there could be an easing of commercial ties between the U.S. and China. That is what, you see in the news. However, one of the important issues focused, embedded in this meeting is whether or not China will open the door for more discussions with Boeing. That froze. I mean, that's the term that's using. That froze for a variety of reasons. One reason was the concern over safety, but once that became fixed, the freeze was still very much in place. The question is now, is Beijing ready to open the door for talks with Boeing? And that has been in the headlines. You probably have seen that in the headlines because they perhaps want to pick up and reset the dialogue with Boeing. Let's stay tuned to that because you're going to see it in the headlines as this conference, this summit opens officially out in San Francisco. And on top of all of that, in terms of what we're going to hear here in the United States, there is more and more Fedspeak. And what we want to see is if they continue with this notion that the Fed may not be finished with its work. And, the data will help. There are over 30 days still between now and the next Fed meeting, and all of these data releases matter. They will be sewn together to see whether or not that last mile of inflation, which still remains sticky, is actually being unwound at a faster pace. So we have quite a bit of Fed speak today and tomorrow and the rest of the week. And then we also have tomorrow, Tuesday, November 14th, the National Federation of Independent Businesses Optimism Index. This is important for me because the small business owners in our country are the backbone, absolute backbone of hiring. We hire more people than we see in the large corporations. We want to hear what they're saying about inflation, what they're seeing about prices, and especially, do they expect to raise prices for their goods and services? Very important, because that is a question that is always asked in this index. We want to hear what they have to say and what they have to say about what they expect for future sales. We'll also tomorrow, and this is the big news, obviously bigger than everything else probably this week, is the Consumer Price Index, the CPI. What is going to show up in the core CPI and what's now called the super core. And that's important because what the super core does, it takes out the real estate component. And we want to see where we go. This can reset the belief that the Fed is finished or that the Fed has more room to go beyond higher for longer, that perhaps they have to raise rates. So anyway, this comes out tomorrow, and it is going to be, as everyone knows, extremely important. And do keep in mind that this is not the Fed's preferred measure of inflation. That is the PCE, the Personal Consumption Expenditure Index, but nonetheless, at some point, the two overlap. The trajectory regarding inflation overlaps. So this is tomorrow. It is going to be extremely important. And many have said this is the most important event for the week, especially following Chairman Powell's comments on Friday. And then on Wednesday, we got a follow-up of the Producer Price Index. And this obviously is important because it gives us the pipeline of prices, and we want to see where that falls. And then also, given the importance of the U.S. consumer in our economy and all of the expectations that the consumer spending is on the verge of a decline, given that we represent about 68% of our GDP, we want to see where U.S. retail sales come in. Are they down? And there'll be a breakdown, by the way, between consumer spending on goods and services, but also auto sales. And then also we are going to start the round robin of territories in the Federal Reserve System of manufacturing. And we're going to start with, as we always do, with the Empire Fed. I'm mentioning this because there was tremendous concern that the downturn in manufacturing had deepened. But many of us have said, well, wait a minute. Much of that has to do with the auto strikes. And that's over. And we want to see, because just before all of that started, it looked as if a bottoming in manufacturing was taking place. So we'll see if it has been somehow manifest in that Empire State Survey, which, by the way, is at the fringe of how we look and where we look for manufacturing strength or weakness. It is New York, New Jersey, and Connecticut. We'll wait until the next one, which is the Philadelphia Fed Survey, which has a higher positive correlation with the rest of the country. But again, quite a bit of Fedspeak tomorrow, and for that matter, for the rest of the week. And then Philadelphia Fed Survey comes in on Thursday. What are we looking for? Again, we're looking to see if there is a pickup where we left off before the auto strike in bottoming of conditions. And as always, with these reports, we look to see what were the new orders, export orders, and hiring expectations. And then we'll have industrial production. I want to point out, again, industrial production down, but we'll see how much of a component came with the strike, the auto strike. And then, again, more and more Fed speak. And then on Friday, we will end. I'm getting bored with this, even saying this, more and more Fed speak, because we're going to have the hawks and the doves speaking this week. And it will have housing starts and building permits. But above all else, the market is looking for any sign at all that the Fed is finished. The market interpreted everything from, 2 weeks ago. The Fed is finished. The Fed is finished. Powell made it very clear. Not so fast. And I want to also mention, we hear this mantra of higher rates for longer, higher rates for longer. The Fed does not know what the future holds. There's no way any central bank knows. So we have seen versions of this in the past. The Fed is going to keep rates lower. Actually, at the very end of December 2021, Chairman Powell at the Fed's press conference made a point in response to a reporter, we expect to keep rates low for a long time. Obviously, real life intervened with that, correct? So we take that almost with a grain of salt. However, we'll see if they, see the need to come in with perhaps another rate hike for one reason, to anchor consumer expectations about future inflation. That would be one reason. And second, that they actually see the possibility of prices continuing to rise despite the higher rate regime that we have. So a lot for the market to absorb this week, but keep in mind, we have most of the market still in a downturn, and we have the big 7 names in megatech continuing to lead this market higher. We'll pay attention to the earnings reports this week as well, which is very much focused on retail. Everything from Home Depot to Walmart to Target coming out with their earnings. But at the same time, we will have some tech earnings, Cisco, for example. And what we want to do is pay attention to what they have to say. So to repeat, a lot for the market to absorb. We'll allow the market to absorb amid a backdrop that we are in overbought territory for the market. And we are facing a debate in DC regarding the budget. So how do I say it? The market likes to simplify things, by the way. And so we should also be thinking in terms of what is the most important as we go through this week. Have a very good week. Take care, and we'll be back next week. Thank you so much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast as set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.